Welcome. In this explainer, we are going to dive deep into one of the most frustrating things that can happen to a trader. And more importantly, we're going to show you how to turn that frustration into what could be your most reliable setup. So let me ask you this. Have you ever been in this situation? You've been there, right? You see what looks like the perfect setup, you put your trade on, feeling pretty good about it, and then bam. The price just spikes for a second, just enough to clip your stop loss, and then almost immediately, it reverses and rockets off in the exact direction you predicted. I mean, it literally feels like the market is out to get you personally. But what if I told you that feeling of being hunted, is actually a massive clue to a really powerful trading strategy? Well, what you've experienced is a classic liquidity sweep, or as a lot of traders call it, a stop hunt. You have to think of all those stop-loss orders sitting at key levels. They're like a giant pool of fuel. The big market players, they know exactly where that fuel is, and they will literally push the price just far enough to ignite it. And that sudden burst of orders is what gives them the power to make their next big move. So we're going to learn how to spot these traps. That way you can stop being the fuel and start being the one who profits from the fire. All right, let's get into the nitty-gritty of it. Here's how we're going to break it all down. First up, we're going to look at the anatomy of the trader's trap. Then we'll get into the core reversal idea that flips this whole trap on its head. After that, we'll give you the exact blueprint, the conditions, and the execution. Then we'll cover a crucial trend filter to really stack the odds in your favor. And finally, we'll go over the red flags and the golden rules to keep you safe. Okay, this is really the heart of the whole thing, the core reversal idea. It's a surprisingly simple concept, but it's so powerful. And I guarantee it's going to change the way you look at the market. So here it is, the golden rule. And it's this simple. We do the opposite of what the market just pretended it was going to do. If it fakes a move down and sweeps the lows, we get ready to go long. If it fakes a move up and sweeps the highs, we get ready to go short. It's a pure reversal play, and it's so effective because you're literally trading on the back of what the big institutions are trying to do. And here you can see it perfectly, the two sides of the coin. Over on the left, we've got our bullish example. You see the price dip just below that old low, grabbing all the liquidity from the sell stops, and then it snaps right back up. That's our signal to go long. And on the right, you've got the bearish version. Price pokes just above that old high, triggers the buy stops, and then reverses hard. That's our cue to enter short. The key thing to remember is that we are always trading against the direction of that initial sweep. Okay, so you've got the big idea. Now, let's get into the actual mechanics. This is the blueprint that turns that concept into a repeatable trading plan you can actually use. Now, these are your non-negotiables. You absolutely have to see these things line up before you even think about placing a trade. First, you need a clear, obvious level where you know stop losses are probably sitting. Think a previous high or low. Second, the wick of a candle has to break that level. But third, and this is the most important part, the body of that same candle must close back inside the previous range. That's your confirmation that it was a fake out, a trap, and not a real breakout. And finally, you want to see the next candle start moving with some strength in your intended direction. So let's walk through a short trade, step by step. First, we watch the price sweep above a key high. Then we rate. We need that critical candle close back inside the range. Once we have that confirmation, and only then, we enter short on the next candle. Our stop loss is placed just a little bit above the high of that sweep wick. And for our target, we're aiming for a previous low or maybe an old demand zone, somewhere we know buyers showed up before. It's a really clear, logical process. And for the long trade, well, it's pretty much the exact mirror image. Price sweeps below a key low. The candle closes back inside the range. We enter along on the next candle. Our stop goes just below the low of that sweep wick. And this time, we're targeting a previous high, or maybe an old supply zone where sellers took control in the past. It's the same logic, just flipped upside down. All right, now this next part, this is what can really take this strategy from good to great. We're going to add a layer that we're calling the pro filter. Honestly, this is the kind of thing that separates the consistently profitable traders from everyone else. Okay, look at this number, 70%. I just want you to let that sink in for a second, because that number is the key to understanding just how powerful this filter really is. So what's that 70% all about? Well, it's about this one simple filter that's designed to weed out a huge chunk, up to 70%, of the potential losing trades you might otherwise take. And how does it do that? By making sure you're always aligned with the overall market trend. Think of the trend like a powerful river current. The big institutions are the ones creating that current. By only taking trades that go with that current, you're putting all of their immense pressure at your back. It's like swimming with the current instead of fighting against it. Think of this table as your cheat sheet. It makes it super simple. When the market is in an uptrend, we only look for long trades after a sweep below a low. And when the market is in a downtrend, we only look for short trades after a sweep above a high. We completely ignore everything else. See those big red X's? That means we avoid sweeps that go in the same direction as the trend. This one little rule keeps you on the right side of the market's momentum. You know, knowing when to trade is important, but knowing when to sit on your hands and do nothing, that's just as crucial, maybe even more so. So let's talk about the red flags, the times you see this setup, but you just stay away. So if you spot any of these red flags, your job is simple. Just stay away. If the market's in a crazy strong trend with no pullbacks, that's like trying to stop a freight train. Don't do it. If there's high-impact news coming out, all bets are off. And if that sweep candle is just massive, that means your stop loss would be huge and the risk is just too high. Our goal is to find low-risk, high-reward spots, and these conditions are the total opposite of that. And finally, let's talk about the golden rules for this setup, the opposite direction liquidity sweep setup, or ODLSS. Think of these as non-negotiables. Rule number 1, and it's the most important, you only enter after the candle closes inside the range. No exceptions, no jumping the gun. And for you options traders, there are a couple of extra things to keep in mind. Try to avoid that last hour before expiry because time decay really starts to hurt you. And stick to at the money or near out of the money options. That just means you're picking contracts close to the current price, which gives you a good balance of risk and reward. So really, if you boil this entire strategy down to one sentence, this is it. It's a precision setup. Liquidity gets swept on one side, and we, as traders, enter in the opposite direction, with our target being the liquidity on the other side. That's the whole game in a nutshell. So the big takeaway here is this. The next time you see the market make one of those sudden, sharp moves that used to stop you out, I want you to see something different. Don't just see a trap anymore. Look for the trigger. Because now you have the blueprint to turn what used to be a moment of pure frustration into a high-probability trading opportunity.